which was expected. The 8:30 timeframes gave us our core PPI numbers, and they came back in lower than expected. Our PPI number, core came in lower, but PPI was expected at 0.7%, and it came back at 1.1%, which was higher for core, or excuse me, higher for headline. And the unemployment claim numbers came back at 229,000, which was higher than expected. So you have a lot of mixed signals here this morning. You could make a case that higher PPI number is bearish, for the broad markets, because it pushes a rate hike or pulls a rate hike further into the future. And then the unemployment claims number is higher than expected. The labor market weakening would pull a rate, push a rate hike further out into the future. When you're looking at this from the perspective of the Fed Fund futures and where we were this morning, nothing has changed. We're still pricing in a December 9th, 2026 rate hike. It has the spreads have widened a little bit here, 40.7 and 40.6. So there's quite a lot of room, a lot of wiggle room there between where we're pulling a rate hike into the future versus pushing it back out. And what would that suggest? I think you could make a case again for sideways and a churn, sideways to lower for the indices. We're looking at our regime tracker here, and really want to focus on this, because when we had a streak into the boom, it was about 2 weeks long, and then we had our first retracement from June 2nd to June 1st to June 2nd. So on that morning of June 2nd, that's our high. That was the high of the market so far. We stayed on top of a deflationary bus pointed in that direction from June 2nd to 11th. And then on the 12th, or I should say on the 10th, we made a retracement. Think of the retracement into the boom as a squeeze into resistance on the indices. It's like we had a short covering squeeze into resistance, and then it retraced back, and it's pointed back into the bust. It's pointed back into the bust. And this is the combination of the S&P 500 priced in crude oil and then gold priced in treasury bonds. And so you have this environment here where what's safe? Well, it's good for the currency, but it's energy inefficient. And so that's a dollar strength trade. The dollar goes up. And bonds aren't a safe haven anymore. So it's just a dollar strength trade. And that leads me into giving the context here for the dollar. And this is, Richard, going to answer your question here. Why would there be the potential for a breakout? When you look at the longer term time frames and you go back in history and you look at these fourth year in a cycles, this is the time of the cycle where you're anticipating, I know it's kind of parabolic, but it's real. We have this '08 consolidation down here, which we broke out of in the end, going into the summer and into the autumn of 2008. It was May, June, July, '08, squeezed into 50% shorts. Anybody that remembers that, it was a dollar. This stream continues at emoneyaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.